We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
You got to have the why, and we know our why. So
you don't need to reinvent the wheel. Yeah. Millions and millions of people have done this already. You can get help, you can get a roadmap, you can save a lot of time, money, and frustration. Welcome to the Value Add Podcast with K&K.
Welcome back, everybody, to another episode of Value Add with K&K. Today, and only today, I don't know why I said that, we're talking about commercial financing with the Mitch and Krystle. Welcome. I said welcome.
Hello.
Wake up. Hello. Are you there?
Hi.
So today we're going to talk about loans.
Awesome. We're excited.
We're going to specifically talk about commercial loans, and more specifically I like to talk about, because you guys are getting, I like to talk about things that I hear about from clients. It's because I'm sitting there and I listen. I think you guys are getting a lot of purchases, a lot of refinances. And I think when we're in a market like this, financing is very competitive. Like, everybody wants to lend, right? Banks are the rates are good. Everybody's lending, they're refinancing. And a lot of people don't know where to go. So they're looking at, do I go get a bank loan? Do I get Fannie loans? Things like that. So today we're going to talk about the difference from a bank and Fannie Mae loan. So I want to start there. So Krystle or Mitch, tell us the difference from a bank and Fannie Mae loan, and then why would you typically use one or the other, and what's the advantages?
Well, I would say, just to start, in some of the core markets, like where we're at in San Diego, I've really tried
What's a core market? Explain a core market.
Like a large city. So if you're in San Diego, Los Angeles, San Francisco, and then if you go outside of California,
if I'm in Palm
Denver,
Desert, is
Seattle,
that a core city? Palm Desert?
No. It's a little bit small and a lot of land, So in cities that are more dense and urban, I would say, a lot of times there is some really competitive financing available. So I have found that we don't really have the need for the small balance Fannie Freddie stuff, because we have lower rates available with banks, and the closing costs for that type of loan are much higher than a typical bank as well. So you're looking at like $12,000 to $14,000 in lender fees, including your appraisal and everything, but about $14,000 because you have legal to deal with as well.
So quick
included
question.
In that. So that's expensive compared to a bank.
So Mitch, quick question. Because somebody's listening to this that doesn't understand loans, why does a bank not want to go lend? Why does a bank want to be aggressive? Like, I know San Diego, Orange County, LA, it's like some of the most aggressive financing in it's the place to lend, right? Why, if you go to Palm Desert, they're like, yeah, we're not really interested. And how can they legally do that?
Yeah, banks, they really can't get away with that. For commercial, it's a little bit more open-ended on their front. It's not redlining or blockbusting or
no RESPA.
It's no RESPA, but it's a business loan. And in some of those outlying areas in the past recession, a lot of banks took losses because in the downturn, people lost jobs, vacancies went up. Apartment owners were defaulting because they had 10, 20, 30% vacant, and they couldn't pay the max leverage debt. So lenders have got a little more cautious. They, qualify those a little bit harder. They give more restrictions on loan to value, where, an agency product, they're across the country, same guidelines.
So they're like a 120 DCR, up to 80% loan to value. They may price up for some of the if you're not in a major MSA, they may price up a little bit, but they'll still lend there to the same guidelines.
It's almost like with residential Fannie and Freddie, it's like if you go in these rural areas, nobody wants to touch it but Fannie and Freddie.
They do a lot of business there.
And it's a lot of because the banks really just like to focus on core markets because that's where the boom and hustle and things are happening and people live. And when you go outside, the density is less and less and less, which is more and more risk technically, right?
Yeah, and they've also got a larger portfolio of performing loans and a bigger portfolio. So if they do have a loss here and there, it doesn't hurt them nearly as bad as a bank who has to write off that loss. It affects their total amount to lend, and they'd rather get aggressive for existing clients for their footprint, where they've got branches or where where they're located, where they can check on the property, that sort of thing.
So, Krystle, you said the difference from Fannie and a bank is basically, you said one of the things is fees.
Yeah, the big thing that I notice with clients, I mean, there's two things. So their small balance program rates are not as
What's a small
competitive.
balance?
So small balance, they do anything from like 1 million to maybe like 5 million.
Okay.
And their closing costs, like I said, are $12,000. When you have lenders out there like Chase that are doing closing costs of $2,000, that's a huge difference in fees. Not to mention that, I mean, we just sized one out the other day. It's interesting because we had a client call and said, hey, I really want to do a Freddie Mac loan, but it's like a $1.2 million loan amount. And I said, well, why do you want to do that? Well, I want a 10-year fixed and I want 80% loan to value. The property's in Lakeside, that's in California, in San Diego. And I was kind of laughing because I was like, well, I don't know what property, first off, in San Diego is going to debt cover to 80% loan to value. But for some reason, he had in his head, he saw somewhere about these Freddie Mac loans. So I said, okay, fine, I can get you pricing for that. I can probably beat the person you already have a term sheet with. So we got that term sheet for a Freddie Mac small balance loan. It was like 20 basis points higher than our next, like lowest rate. So we ended up going with a bank and having less fees and a significantly lower loan amount. So I think we quoted him like 4.6.
Lower rate.
Yeah, lower rate. I think we quoted him like 4.69 on the Freddie small balance program. And that was going to be like the $14,000 in cost plus our fee. And then we gave him like an actual 10-year fixed, another bank 10-year fixed at 4.35 with much lower, like about $5,000 less in closing costs than the Freddie loan. And then we gave him a third option, which is cool, a 5+5, which means that he's able to lock in his rate for 5 years. You get a much lower rate, so it's 4.1. And then in the second 5 years, it adjusts one time, and it can only go up max of a half a point. So the max half a point, it goes up to 4.6. That's absolute worst case, and it's fixed again for another 5 years. So it's still lower. Their worst case 5 years down the road is still worse, or is still better than Freddie's 4.69 that he was going to get.
So basically, it's making sense to go, if you're going to do a Fannie or Freddie loan, it probably, because rates are good and banks are competitive here in San Diego, we're talking about.
Yes.
If you're under 5 million, you're probably at this point in time going to do better at a bank.
Or yeah, and we even had another one that we priced out recently, larger loan, so a $4 million loan amount and a $5 million loan amount, like 60 to 65% loan to value. And we priced out, they wanted a 7-year program. We priced out the 7-year. It's basically the exact, it was like basically the same rate that you could get with a bank. And then this morning we got reduced rate. So they were actually, the bank was 10 basis points lower than the Freddie small balance program. Again, lower fees across the board to close. So,
for example, that guy came to you and he wanted a Freddie loan. In his mind, he's like, I want a Freddie loan.
Yeah.
So did you contact him today about the new rate going down?
No, not yet. I mean, and those loans are different. I mean, it's no, we haven't. And
Okay.
He's actually looking at a different kind of situation with prepays and things. But in comparison, it was like, let's maybe go to Freddie because, they're really pushing. Freddie's really pushing to do more business. So they're really out there trying to give rate concessions and everything to do better. But the problem is in San Diego, we just have such competitive financing available that this financing is super competitive if you're not in a core market.
Like if you're in Arizona or Nevada, they'd probably be crushing it.
They're crushing it.
That's the place to go.
They're probably the primary
Texas,
lender for anything over $1 million.
Texas, Ohio. I mean,
you name
anywhere in the Midwest, anywhere that's not coastal, to where, if you have above a 6% cap rate, then the agency products are pretty good because you can get the max leverage on those.
Oh, you can go to 80.
So
people do go to 80.
You can actually do 80%.
You're looking at 75, 80%. You're not going to get priced up for being in a smaller market as much as you will with a bank. They're going to limit their LTV. They're going to limit their exposure to those areas. But with the agency products, you can get pretty aggressive on there. And then there's other kind of add-ins that you can do with that too. So they start with a yield maintenance prepay.
What is a yield maintenance prepay?
So basically just assures that the bank's going to get their full interest for the term of the loan.
And
No
they're
matter when you pay off.
No matter when
yeah.
you
but
pay
they're,
off.
but they're
so-
they're crazy. Like people don't understand. Like some people, we have people they literally got I got a 10-year and they didn't really understand and they go hey I want to pay this off, I'll pay the prepay, and they get it. They're like $1 million.
Yeah, so the most recent one I saw that kind of knocked me off my chair was the lady owes $850,000. She's paid the loan down and her prepay was $125,000, which is crazy. And she's got like 2 years left on the loan. So with the step down prepay, it'll be like 5% in the first year, 4% in the second, 3, 2, 1. So you know what your prepay is going to be at any point you pay off. Like that worst case, $850,000 even at 3%. I mean, you're nowhere close to that. So
Because people will pay right now. I mean, sometimes it's smart if you can get cash out and rates are good. Some people are like, I'll just pay the 1% because they're like,
yeah, sometimes it makes sense to pay the prepay because hey, I'm coming up on an adjustable in 2 years. I don't know what rates are going to be in 2 years.
plus
Or you need
I want
I know they're
cash.
low.
or
I know they're low
you wanna
now, so
sell.
I'll pay the prepay now. I'll pull cash out. Enough cash to cover that.
Values are good. It's a good time.
I've extended my fixed period out, so it's a great time to do that. So we do see people paying prepays, but with yield maintenance, it's unknown. If the rate market is higher at the time you pay off, it's not going to be as as much of a shock. But if the rates are lower and the bank has to lend it out at a lower rate, they basically charge you the difference on that. So. With the agency, there's the option to get a step-down prepay, a reduced step-down prepay, options to do interest only. So there's a lot of really
there is
cool
a
stuff
hit
you
though
can
in rate
do.
though if you do it.
They're all hits to the
Yeah,
rate.
they're all hits to the rate, but there's the options out there, and like I said, they'll get aggressive in the core market or the non-core markets. So
And bigger
anything
deals.
like 6 or 7 cap or above, you can get max leverage on those, and that's where the agency really comes into play.
Now, as an example, like we recently did get a loan request, or we've had a couple loan requests actually in the desert, and not even Palm Springs or Palm Desert, like Desert Hot Springs as an example. We are not doing agency debt because we do actually have a lender or a couple lenders that can be aggressive there. But the vast majority of the lenders that we called initially were like maxed at 50% loan to value.
Yeah.
Or maybe 60 at best. And then we found a lender that will go to 70, not 75. And again, we're going with the bank program because, again, they have the step-down prepay. They have a pretty good rate considering we're in Desert Hot Springs, still better than, what Freddie could maybe do. So we got that loan request recently, but those are the kinds of markets where, let's say you have a decent size deal and you're not finding really any lenders that are lending, where when most lenders are capped at 50 to 60% loan to value because they
if
don't
you have like
love
a
the
100-unit
area.
deal out there, you're going Fannie or Freddie probably.
Yeah, like more
yeah.
than likely. Yeah, I would say it's like almost guaranteed that's what you're doing.
And so one of the things that obviously we talk about all the time is that if somebody's buying a 10, 20, 30, 40, 50 and up $1 million deal, most of the time people are doing,
Agency.
or
There's
they're
agency or life companies,
companies.
or there's other types of structured debt for those.
And the thing
But
with
Fannie and Freddie are
Oh,
killing it right now
yeah.
in that loan dollar range, like that kind of like 10 to 50 million or 60 or 80
whatever,
or
yeah.
whatever, going from there. That's where you're hearing some of these big apartment owners are like, I locked in for 10 years,
At 3.5.
interest only at 3 and 3.75 or whatever, 3.5%. Those are like the Fannie Freddie deals because they also they look to at like affordability and things, so you can get different types of credits based on location, unit mix, and the average rent. So they have their own kind of matrix in-house that they plug in all this stuff, and they can give you different sorts of discounts on top of the fact that, like I said, Fannie and Freddie are really pushing to increase their volume right now. So they're giving pricing incentives like pretty regularly on like pretty much every deal. So even their rate sheet pricing, they can probably go a little bit lower than that on any deal.
And then the other good thing is you can get them to compete against each other too, because
that's
they
what
don't
the
like losing.
that's
so.
what the big guys do. The other thing is I think to talk about is we talk about why would you do bank or Fannie Mae. I think people need to understand too, when you're buying stuff that's probably, let's just call it here, maybe 100 units and below in San Diego, bank financing is great because your buyer that's going to buy that is might not be a person that wants a Fannie or Freddie loan, because the reason is they might want to pull cash out or turn the unit. But when you go 100 units and up, the buyer could be a REIT or syndicate or something
And
bigger.
they have to do non-recourse too.
They want
so-
non-recourse, but they're okay with assuming your loan. So I want to talk about that. The other advantage about Fannie Mae when you get into a bigger deal or any deal, let's say, is the debt is assumable. Can you talk about how that works and the process and cost?
Well, pretty much all debt is assumable
Okay.
when it comes to multifamily. So
That's
whether you're
nice.
doing a bank loan or you're going with agency debt, they're pretty much assumable. The big reason why people are doing agency debt outside of it being really competitive, it's really competitive. They offer full term IO,
Which
which
is
lenders
awesome.
are not doing. And they do offer non-recourse. So if you're a syndicator or you're a REIT, you have to do non-recourse because you've got all these investors in one deal that are not going to be putting up all their financials. So that's the other great thing with the agency debt is that they're getting that up front, and that full term IO is like really crucial, I think, when you're a REIT or a syndicator, because you've got to give, a return back, and then you've got to kind of like hold back still for reserve. So that IO is really crucial.
Just to
for a lot of
confirm,
people.
most banks, Mitch, are they recourse?
Most start recourse. We do have non-recourse options for a lot of them, but a lot of times it'll be a pricing bump where it's built into the pricing.
It makes a
agency debt.
difference, huh?
It does make a difference, especially when you're getting to the larger
And-
loan dollars. 10 basis points is thousands of dollars.
If big loan, yeah.
Yeah.
And that's where agencies are really crushing it, is on that big stuff too, because most banks are not going to get as competitive as you're going to get with agency at that level with IO, with non-recourse, because our lenders that are doing IO now are offering 3 to maybe 5 years IO, and there's a little bit of a bump to the pricing. Sometimes they can waive it just to be competitive if they need to, but typically there's a bump, and then you get the non-recourse bump in pricing. So agency really is the way to go once you're pretty much over, like, I would say maybe 10-ish, about 10 million.
Yeah. And with the assumability, like a lot of the REITs, they'll go with the yield maintenance prepay because they're just going to require the buyer to assume it. And if they do assume it and there's significant equity, a lot of times the buyer can get a second trust deed with the agency behind that to kind of bridge the gap and the additional debt. And that way, they assume it. The seller doesn't get that yield maintenance prepay, and they still are able to finance the max leverage.
So I'm thinking here a couple other things that I want to talk about. One is with commercial financing, and it's some of the stuff I'm seeing come across your desk is people that might have had a recent foreclosure, a bankruptcy, or their credit's crap. In my world, there was no options. There has become, but it's significantly limited, and you can be significantly penalized. The other thing I want to talk about that, and then the other thing to go into is I got a call from somebody. It's like, hey, I don't show any income, but I want to go buy this 10-unit building. Can I qualify? And so they're so used to residential where they're like, everybody's just so scared that if you don't show income, you don't have a good credit score, you're not going to get a loan. And so can you guys kind of go through that scenario, like the credit, how big of a role does that play, and how do you guys get around that, or how do you manage that? And also how important is somebody that they got to be a W-2 to show income to go qualify for a 10-unit, 100-unit, whatever it is?
Well, this is a question we get a lot from people who are just starting in multifamily. So, because they come from
My world.
your world of like going through a nightmare just to get a loan.
Totally.
I would say apartment lending is a lot easier than residential because we use more common sense than
What?
Yeah, we don't just like have an underwriter that looks at a piece of paper with like guidelines on, it either fits in the box or it doesn't. To some degree, we do have that, but it's not to that level. So when it comes to credit scores, we look more at what's causing your score to be at that level. So like, let's say that you have like a 680 FICO. In residential, that would be not great. And
It's not terrible, but
it's not. But
you
you're
don't want to
gonna
go
get
below
pricing
that.
ads.
If you
You're-
go below
right,
that,
but
it
you're
gets
gonna
ugly.
get pricing ads for
Yes.
you. I mean, your ideal is what, 740?
And
Pricing.
in jumbo, honestly, 780 is 800. You get
You
credited.
get better.
Yeah.
So we don't have that. What we look at, because some of these bigger apartment owners too, they don't have the highest credit score, because they're moving debt around a lot. They have a lot of inquiries because they're buying and selling and refining properties too. They may have a couple of like little court things for tenants that might have taken them to,
Collections
small
or-
claims or something like that. So, and that's all just part of being a larger apartment owner. So there might be some things that might be dragging their score down. I mean, we've even had scores below 680 where if you just looked at it and it made sense, okay, well, this guy's bought 15 properties this year, and so they're
Or
running
he's
his credit
has
like
a
crazy.
significant net
and-
worth. They just basically
Yeah,
are like,
I mean, it's
Well,
just
yeah, they're going to look more at payment history
Yep.
than they are the actual score.
Right.
and if they have big net worth and they've done a
if-
bunch of loans, they don't, honestly, it's like,
Yeah, I mean, if the score is in the 500s, they're going to say, yeah, what's the story here? But if it's 650, 660,
Yeah.
and there's no derogatory, it's just an active.
are you going to get crushed in
report.
pricing if you have a 600 compared to a 780?
No.
If you're strong and you're
No, it's first and foremost we qualify the property.
Okay.
The property has to be able to pay for itself.
But you do- but-
Lender looks at it worst case, like if they had to take it back, how would they operate it and still cover that debt? So you factor the management in, you factor a vacancy, you factor reserves, you factor market expenses, and then they buffer for those. On a refinance, they use either the new value or at least the loan amount for property taxes, where it may only be $5,000 actually, but the property's worth $2 million, so we're going to qualify it at $15,000 for property taxes.
Oh, really?
So they factor in all of these kind of buffers to make sure that in a bad case, in a bad month, the property can still kind of service itself. So we look really heavily at the property. So the personal income, personal credit is not as bad. We're really looking for a 1-to-1 on the global. And if you're self-employed and you've got write-offs because you've done improvements to your property and you wrote those off as expenses, we can add that back in. We can show that that's
And it's not a
that's
battle.
not actual
Yeah.
like recurring
It's
expenses.
common sense.
it's not a battle like what you deal with now.
But you do
Because
have
we also know, I mean, we're doing multifamily, and if there's things like capital improvements and things that are included on the tax returns to back out, remember, this is an underwriter who underwrites these things for a living, so they know that something's off. They're like, hey, you're right, these expenses are off, they're really high, so that they'll probably even do, because they again use their common sense, do a quick search on the property and they can see online, oh wow, this looks like it was recently painted and this unit's like brand new. Okay, well that kind of makes sense. I mean, they might go that far to look at something and kind of like make sure. So it's not,
you guys can basically tell a story,
we can tell a story.
and it's like, okay, I get it.
Makes
This
sense.
is the factors, and let's move on. And my thing, you can tell a story. They're like, sorry, we're just, if it's not on there, we're not going to use it.
We can operate in the gray. It's not black
Yeah.
and white. There is there's circumstances for a lot of the questions that come up, and if you can answer them and present the package correctly, we can look at what makes sense.
What about bankruptcies, foreclosures, short sales, things like that? Are you guys able
We
to
don't
get?
love that, but like it happens. We've had some clients, and most recently we had a client who had a foreclosure on their record, and it wasn't old. I mean, it was 2016.
2016, yeah.
And we got him a rate in the 4s with cash out on his apartment building. So we're not here to kind of advertise this, but if somebody's gone through a hard time or something came up of that nature, it was literally a foreclosure on real estate, but we were able to, again, tell the story, and their credit team, the bank's credit team, accepted that, and they were willing to give the loan. Now, that being said, it's like kind of a prime location.
Yeah, and it was extenuating circumstances.
Yeah.
And,
He didn't have a lot of other
know,
stuff, probably. huh?
That was the only derogatory
So
on
that
the
helps.
credit.
Yeah, nothing
the credit,
else.
yeah, the score had rebounded, so we were able to get around that. I think one thing I want to say on that is, if there is any kind of issues, don't hide it. Like,
Yeah.
let us address it up front. Let us,
Because you've had people hide it and they catch it in the end, huh?
Yeah, and if you hide it and we catch it in the end, the underwriter's already got a bad taste in their mouth for it. So
Yeah,
you can't. It's tough to change their mind once they've made once they've kind of
When
Because
you
you've,
give- when
you've
you-
lost
Yeah.
it's essentially lost trust.
you lost credibility.
And they're gonna hold they're holding your loan for 5 years and servicing it. Like, if you're lying to me, then I don't
Yeah,
want to be in that
so-
relationship.
So if there is any kind of issues, address it up front. Take care of it. Most of the time, it is something we can get around. So that's the the biggest point for credit foreclosures, bankruptcy, like address it.
And we've gotten around bankruptcies, that fairly recent bankruptcies as well, that had a story that made sense because, again, in the last downturn, a lot of people took a hit. So where it made sense, and again, we're looking at this more common sense too. If someone had to file bankruptcy, they kind of look at what type of bankruptcy and what was given back. And, there's a whole bunch of factors that go into it that maybe there's
partnerships have gone sour. Any number of things where, partnerships are probably one of the
biggest
ones that we've seen that we're able to get around, fairly easily with a story. Somebody may have, been overextended and one partner was, fairly conservative and, they have to BK that company because, the guy that's conservative is not going to float the partner that, leveraged everything.
Or stole or whatever.
Or whatever it is.
Yeah, so we've had some of those scenarios and we've gotten loans done at competitive terms and rates. So if you have any of those situations, it's not 100% you're not going to get financing or that you have to take some terrible hard money loan or anything like that. That's always there if you can't get the loan. But again, I would say you're probably looking at, we're here in San Diego or LA or Southern California getting these types of deals done. If you're in like Timbuktu with your small little property, you're probably going to have a harder time with that. So if you're in a core market, though, there are lenders out there.
California is one of the best, probably, if not.
But also, too, deal structure is always important. But when you have those sorts of issues, that's when it can be really helpful to work with someone like us to properly structure it because we can also have conversations. We have the relationships. We have experience with multiple closings. We know exactly which lenders would consider this or not. We've had that situation where a client's already, they've come to us and they've already shopped all over town, every single lender. And they're like, oh, yeah, I saw this deal. Oh, I saw this deal from 2 or 3 different people. And people go like, well, I've got to shop the best deal. Yeah, you're right. But you also need to pay attention to how you look to a bank and being that person.
Presentation.
Yeah, it's the presentation and who did all these other people and how did you present your deal and
what's your relationship with the bank?
Yeah, but also too, like if
then.
I'm going to present it and a bank's already seen it 3 other times, I don't know what the other person's presented. I mean, I'm going to present it in my best light, but if it looks different the last few times they saw it, they've already
looked at it. They may not even review it again.
Yeah.
So it's, again, that's going back to the being up front and, having everything, all the cards on the table. If they've seen it and it didn't make sense, the underwriter's already made their mind up. You're gonna have a tough time convincing them otherwise. So that's where you don't want to have 10 different people presenting it because they're going to present it 10 different ways. You want to work with a professional that's going to put it together and
has experience
and that has experience that's dealt with this. That's that can kind of guide you going into it and take the time to address the concerns up front to make sure you're not going to get the rug pulled out at the 11th hour.
Do you guys do stated loans? Do you have programs where you don't have to show tax return? So if somebody's tax return just looks really bad, their business lost money or they're negative.
Yes.
So there is.
So we have a couple of programs that don't require tax
with
returns.
competitive rates.
Very competitive.
Okay, cool.
Yeah.
So even some of the agency programs don't require tax returns.
What's something else you guys are seeing right now that we should be talking about in the current market with refis, purchases right now? I'm noticing a lot. I don't know why, but maybe you're just Krystle's kind of back into the lending game, because you've been doing property management for so long. You're back and getting a lot more deals, and you guys are doing a lot of purchases. But it's kind of funny because there's a lot of conversation. People coming with this Fannie debt, Fannie, and all of a sudden you're educating them because you have experience, and they're like, "Wow, I never thought about going this way." Because I don't know why some people just go, "Yeah, let's do a Fannie loan, just do it," and nobody's pushing them. Maybe they're going straight to a Fannie lender that doesn't broker to other banks. But what else are you guys seeing besides that kind of transition? What else is going on?
Well, we've seen the purchase market be a little bit more active, less competitive, where all the deals are going to the big players. So that last year I want to say it was a lot of the same people we were seeing that were buying all the deals come through. A lot of them were
spread
off
out
market. Now it's spread out a little bit. So properties aren't, you're not getting bid up on the properties to where they don't qualify, and you're putting 50% down, and your average buyer can't do it. We're seeing them start to pencil out a little bit better, where they're trading at 5.5 cap instead of like a 4 cap, or and that's going to be in your.
It depends on what area you're in.
Do you think because obviously there's so much exchange money too in the last?
There's a lot of exchange money, and rates have gone down a little bit. And also, too, I think there was, when rates did go up last year, there was a lot of nervousness about what the market was doing and whether or not we were heading into a recession. Everybody keeps talking about it, and we've had a good, strong market for a while now. So that's the big question everybody asks. It's funny because we had somebody on. Yeah, everybody's like, do you think a recession's coming? Are we headed into a recession? So I think some of that's been alleviated with the low rates. And so people have felt comfortable again to start becoming active.
Kind of the same thing in the residential.
Yeah. So, I mean, people are feeling more comfortable. And you're right. Our pipeline is more full now with purchases than I remember it being for a long time.
Yeah,
So,
we were pretty refinance heavy for the past couple years. And
Did you have you guys deal with a lot of active clients?
Just a lot of active clients, and we're seeing a lot more purchase activity, a lot of new clients that are buying their first deal, their first apartments, and they're getting offers accepted now. Where like I said before, we were seeing people have to come in with 50% down just to make a normal deal work, and that's tough to get into your first deal. You're
50%. Raise the rents, fix up the property.
Yeah.
It's a lot more than that.
And
yeah,
all the capital for the improvements.
Yeah,
and,
it could be $20,000 a door, $25,000 a door. So you got to put 50%. But so people are like, they don't realize that's a lot of money.
Plus you got to have the reserves. Plus you got to have
vacancy,
the time. That's the other part. So we've seen more. Some of the properties that have been rehabbed where they're turnkey, they're ready to go. So an investor can go in and buy it that just wants an investment property. They don't want a project. So we're seeing more of that stuff coming around now.
The other thing I think that's big right now is even in residential is a lot of people for residential, we're seeing a lot of people, their arms are adjusting now, but they're going up. So they were able to, even if they're adjusting when the rates were low, they're like, oh, it was great, but they went up with the adjustment because the index went up with the margin. And I know you guys, as most people refinance, it's 5 to 10 years, but you guys average probably loan is 5 to 7 years.
5 to 7 years.
And if you have a 5-year loan, is the prepay 5, 4, 3, 2, 1, or because it's 4?
Not necessarily.
It could be different, but some people are like, I got a year out. A lot of people are calling you saying, let's refi, like extend, lock in, take cash out. That's a big thing that's going on right now.
Rates are low right now, so if there's no prepay, a lot of people are jumping into refinance, and at the worst, not even if they're not pulling cash out, they're extending their fixed period.
And a lot of people are doing IO now too.
Yeah, you can do interest only, or you can do a new 7-year fix. So instead of having a year left before you go into that adjustment, period, you've got 7 years.
Let's talk about the IO. I think a lot of people, when the market was down, a lot of people were not doing IO.
A lot of banks weren't offering IO.
Yeah. Fannie's always there offering it because they're dealing with the big REITs, the big boys, and that's just how their model works. Like, and we always talk to people like, why would you do IO? And we'll have the same conversation again. It's like, if you're buying these guys that buy $100 million building and they put $30 or $40 million down, let's say, right? They put $30 or $40 million down. That's a principle right there. They owe this. They want a return on the 30 to 40 millions down to their investors.
Let's bring it down to the normal human being that's buying a $2 million deal that's putting
40% down, let's say.
40% down. Let's say they're putting down like $800,000 or $900,000. You want a return on that money too. That's not chump change. So if you have a fairly conservative deal and you want to cash flow, you may want that cash flow because not just because that's what I put down and that's what I have in. Maybe you have plans to fix up the property and maybe the rents are low and you need to raise rent some and you think there might be some turnover. So you want to be able to utilize your cash flow to make improvements to the property, which is perfectly,
We did that with one of ours.
Normal.
In Old Town.
Yeah.
We sat down with our partners and they weren't even looking at it. And I said, why don't we do IO? They said, well, why? I said, because you're going to save this much money over this much time and we can put in the bill. And they're like, oh yeah, without reducing your cash flow.
So
and
the
if you
bank's
don't,
not,
you're not going to get the distribution you want.
the bank's not at risk. Yes, you're right. You put money down on the purchase of the property.
You have to put
but
more
you
down
can,
usually
you
too,
can
right?
your principal reduction is usually fairly small. So you can take that principal reduction and actually reinvest it into the property to increase cash flow and therefore increase value. So, I mean, I'm a big fan of the interest only. And honestly, I think banks started having to offer interest only because Fannie and Freddie were offering it and they had to do it to be competitive. So they were getting some of these deals. And there's still a decent amount of banks that don't love IO. I think they're still kind of warming up to the idea, hence the reason why they're only offering. Most banks are offering 3 years of IO. Some are offering 5, very few. So yeah, now they're offering just a little bit of an IO period. Now, the one thing that people might not know about that is that if you do, like, let's say a 5-year fixed with 3 years of IO, there's a couple of lenders that will not re-amortize after the 3 years of IO. So they could have it amortized over 30 years. But the majority of the lenders for IO are going to basically use a 27-year amortization after that IO
So your payment
period.
would go up.
So your payment, well, we ran the numbers on it, and if you're doing 3 years of IO, and after the 3 years, your payment is actually about the same. It's like a few dollars difference. It's maybe less. It's basically not really going up on the payment unless you're rated on the adjustment. If the rate adjusts up, obviously it's going to, but it's really
Well, on
roughly
interest
about the same.
only, if it re-amortizes, your payment does
Yeah.
does jump, because you're going from interest only to P&I, but the difference in what the P&I payment would be from the 30-year to the 27-year isn't as dramatic.
Yeah.
And I think the one we ran was the 5+5 program.
Oh yeah,
where-
that was the 5+5.
So
yeah.
when it re-amortized, that re-amortizes over 25 years in the second, but you've already been paying principal in the first 5 years, so
Yeah, you're
there's
right.
not much of a difference on that.
So on
even
the
at the worst case.
On the IO, we ran it, and even on ours, the IO payment versus
So
the
yeah,
P&I.
I think what we ran was that the your savings over the interest only period are at worst case negated if it re-amortizes. So you're going to be paying the same amount over the fixed 5-year period if you do interest only in the first 3 years, and then it's amortized over 27 years for the last 2. You're essentially paying the same amount, but in that case you just make sure you only have a 3-year prepay and refinance and get another interest only in there, because you
Just make sure you understand what you're getting into. And like, for example, on the building we're going to close on, Mitch, what do you think the difference is just in monthly of like money we're going to put in our pocket from IO to principal and interest?
we calculated that it was like $5,000 or something, right? A month.
Yeah, something like I think it was about $5,000 a month additional cash flow.
Yep.
So you're looking at $60,000 a year.
Yeah. So about every $1 million, it's probably around
Around $1,200.
$1,200 you're
Somewhere
going to
right around
save.
there.
Yep. So when you start getting into,
Of course, depending on the the interest rate and everything else.
exactly, yeah.
That was a little bit higher interest rate, but it was the 5-year fixed, 5 years of IO, so full term IO.
And we could have qualified for, I mean, I don't know how much more loan dollars, but a little bit more if it was principal and interest.
Yeah, for principal and interest, you could have qualified.
How
for
much more do you think?
$300,000-$400,000.
Oh,
more
really?
on-
It's that much
'cause
more?
We can
Wow.
go to a lower DCR, lower rate, everything else. So.
Well, I didn't realize. I
But
thought
when you look at like an apples to apples, and in that case,
I mean, it's a bigger loan. I mean, it's not like
yeah, and in that case,
that's a 3 point. What is the loan? What's the loan amount so people know what we're talking about?
$3,850,000.
So $3,850,000. If we would have gone PI, we'd have been at 4.2 or 150 or something.
4.1, 4.2. But
Okay.
you didn't want to get that high because you're exchanging into that, and
Oh no, totally. I'm just
you're
talking
using
numbers
the-
with
yeah,
people.
the 3.8 is where we needed to be to use all the exchange proceeds and replace all the debt.
And we're good to go.
So the 1031's fully satisfied. So you didn't need any more. So we didn't press for any more.
And it is. And I mean, so although banks don't like IO, you are putting down more money, so that's a good thing.
Yeah, you're gonna get You're gonna be a little bit more stringent qualifying. So they may hit it with a higher DCR, higher qualifying rate. There's different different factors for different lenders, but obviously we have the relationships with them, so we know if you're looking for max loan dollars, it's not going to be the one that hits you at a 2% higher rate for qualifying. It's going to be the one that hits it may be a little higher DCR.
Every lender's different for the qualifying for the IO. So, as an example, some lenders are qualifying 2% above the start rate, which is ridiculous.
That's like residential. Holy,
and
that'll
It
kill your
kills
loan dollars.
Yeah.
But it basically does that because they want to make sure, hey, if something happens, worst case, they've got the debt covered, you know?
Yeah.
I mean, it'd almost be easier if they qualified it at the full P&I and realize, hey, you're going to have, you know, lower payments, but they qualify it higher because they want to make sure that, you know, that property is going to be stable and you're not going to have any trouble covering the debt.
So what else are you guys seeing out there? I was trying to think. IO is a big one. Refinancing's a bit. So we basically went through today to recap the difference of Fannie and Freddie, the Fannie, Freddie, and a bank loan, or agency debt we call it. So agencies is Fannie and Freddie, life companies, and like a bank loan. And that, to sum it up, that comes down to prepays, expenses, how they qualify, and then depending on where you are located, not in just San Diego, but throughout the country. We went through credit, bankruptcies, foreclosures, bad credit. That if you have a good story, if there's mitigating factors, that could just not be an issue at all. There's banks that do that, and it's not necessarily you're going to get nailed with a huge, like, half a point hit to the rate, like residential or bigger. We also went through IO, interest only, you know, the benefits of that. You guys are doing, like I said, a lot of people right now are paying 1-year prepays, or they're coming out of an ARM. If you locked in a 5 or 7 year ARM and you got a year or two left, you really should call, whether it's you guys or somebody else, if they have another broker, you really should call and see what's out there and check to see if maybe it's now the time to pull the trigger. Because I think a lot of people forget it's not just that rates are good, but if we go in a recession, things tighten. Values can go lower. People remember it's like somebody, I forget who said, somebody said the best time to pull cash out of a property is not when you're in the middle of a recession, when you want cash because everything's cheap. It's like now. And if you see the smart people right now, like real estate investors, a lot of them are getting well capitalized. They're getting their debt. They're basically extending out their debt. They're sitting on cash. They're getting ready. If there's a correction, 10%, 20%, 30%, whatever it is, you want to be ready to jump on it. You don't want to be in the middle of a recession calling Mitch or Krystle like, I need to get this book. Well, we're not getting the values, and rents went down, and the banks that were aggressive are like, well, they're being more conservative. And on top of that, you know, maybe rates are lower, but look in the recession last year. I know it was a financial crisis, not a recession. So I also want to talk about that. Everybody keeps talking about this whole recession. In 2008, it was a financial collapse. That was not a recession. A recession is usually the typical real estate goes down 20%. In a financial collapse, the real estate went down anywhere from 30 to 70, 80.
60%,
yeah.
70%.
So people I know were so scarred from that. Everybody's like, oh my God, it's going to crash again. And I'm like, we could just have 20%. And even real estate, like we were just talking about, residential real estate, and from fourth quarter of last year just till recently was like dead, slow. Like things went down. Like
We haven't had huge appreciation either. I mean, I think if you look at the appreciation that we've been getting over the last 5 years to even like towards like I'd say from middle of last year till now, we haven't had really huge appreciation.
Well, it just came off the bottom.
Our rent growth has really slowed down. Now, maybe in other markets that I've seen, you know, some articles and things about rent growth still being really strong. So, I mean, I would say that San Diego tends to be a market leader. So when we were going into the financial crisis, I think we were starting to see the signs really early, but we were also one of the first to recover. You know, so I think there were some other cities like San Francisco didn't really have any problems. And there were some other places that we talked about that didn't really have any problems, but San Diego is one of those leaders, I feel like, with the market. So where was I going with that?
I'm not sure, but yeah. So San Diego did recover pretty quickly. So
we haven't seen the rent growth as much in the last year.
Back to the scheduled presentation.
Like,
haven't seen the appreciation or rent growth as much in the past year over year in the past year.
I mean,
and I think that's a good thing though. It's normal. Like I don't, you know,
it's stabilized as you know, it was. Yeah. It was growing.
We don't want crazy growth.
Some places saw. Yeah. Massive, like some parts of Arizona, the rents in the recession went down 30% from where they are now. And now that you go back, you can look at data, and they have recovered 30% difference. It's been huge, but that's because jobs and everything got clobbered there. So that's why because everybody's saying the R word, and now my new thing is somebody really said that they're like, quit talking about 2008 as a recession. That's why they call it the Great Recession.
Well, who'd you hear say that? There was an economist.
There was an economist that he basically works with a lot of residential real estate agents. He goes, I keep hearing recession, but let's get it straight. A recession is typically 11 months to 24 months long. It's usually 20% dip in real estate on the average. And so and then I tell people like this is different also because rates in this recession are already low. They'll go lower. So they'll go lower than they are. If there's a recession, they'll go lower.
We already had, Alan Nevin on the podcast previously. And I think a lot of people are saying that there are no real indicators of a recession. It's just that everybody's getting nervous because it's of the time. Most people that you talk to will say about every 7 to 10 years we go through a market cycle. So it's been like 8 years.
It's been 10 years.
Almost 10 years or 10 years. So everybody's like, okay, where's the recession? It's time, but we're not seeing any signs of it. And one of the things that was really interesting that Alan reminded us is that we don't necessarily have to have a recession every 10
Look at
years.
Australia.
Australia has not had a recession
Since 1992.
Yeah.
And they're probably getting their first correction coming up just because sometimes it's just how it's like getting sick. Sometimes you just get sick, right? It's just how you just get sick. You just get a flu. Sometimes people go, I didn't get a flu for 3 years and you get sick.
Sometimes it's good to kind of flush out some things that are not, good. And like you said, I think you were talking about it the other day, for residential financing, you're not as loosey-goosey as you were. Close.
I showed everybody that I showed you the chart, right?
Yeah.
Like everybody always wants to talk like, oh, we're doing all these bad loans again. You see all these articles, and I tell people, why don't you just ask for the data? Don't listen to some idiot on CNN or those Fox.
Sorry, is all it is. It's talk.
You don't have the stated subprime. It's not.
It's
not
let's just say we did.
Yeah.
So I showed you guys a chart, and basically the chart I showed Krystle, we were doing $1 trillion a year of bad debt, like just shit loans. Right now, that line is like, it's a joke. It's like, I don't even what you want to say. It's like it was like
it's
up here, nothing. And it's like here. It was like it's nothing. It's like. Yeah. My mic back?
I just put it a little back.
Is that better?
Yeah, it's better.
Okay. Paco says he can't hear me. So anyways, basically it's a blimp. So what caused the last recession, now that we have the data, 4 states caused it. California, Nevada, Arizona, and Florida. Those 4 states where all the bad loans were written actually caused a global, that was the start of a global meltdown.
California is huge in its own.
No, that's just
California's the 5th largest economy in the world. It goes by itself.
So, So we should be our own country, basically.
In the world, yeah.
Yeah, we should basically be our own.
So I think people forget let's take a step back. Like that's what the GDP just came out today. We're at 3.2 growth.
That's healthy.
It's the market. Guess what they did? They're like, it wasn't good. The 10-year went down today because they're not impressed by it because everybody's
that's what's
because the market, everybody's fearing a recession. And like Alan said, the reason why we'll have a recession is some crazy thing will happen, or we will just basically will ourselves into a recession. Like you'll start thinking recession and everybody starts acting like there's a recession. So then we just don't buy anything. And how do you get out of recession is people just buy shit.
You got to spend money.
Yeah.
Yeah.
So if we are going to have a recession, now's the time to refinance, pull your cash out, get ready. If you believe it's coming, take advantage of the values while they're here now. One thing you said I wanted to touch on is if you've got a loan that's going to be adjustable, look at what your margin, your index is. Look at where your floor rate is. Good point. Because a lot of times you may not realize it. You're sitting at 3.75, and you're like, well,
what is your guys' typical margins? You know what your typical margins are, by any chance?
2.5, 2.75, and
that's the average.
That's the average, and it's either
over
the 1 year CMT.
What is the
6 month LIBOR?
What's the 6 month LIBOR? What is all that at 2s?
6 month LIBOR I think was like 195.
Is that what it is?
The 1 year CMT is at 240.
Okay, so let's talk about that. Let's just talk about that.
So you
$2 million loan
adjustment. You're going to 5%.
There you go. So $2 million loan, you're going 5. Where are you at right now?
We're new 5 year fixed, 7 year fixed, 4.1. So
there you go.
Yeah, you're a point lower if you fix in now instead of who knows what it's going to be in a year or two if you think a recession's coming. You're not going to go lower than where you're at now, but wouldn't you feel better locking in for another 7 years, pulling that cash out and have the buying power if we do go into a recession?
And the other thing is you were mentioning to call somebody, like call us or call someone like us. We don't get paid until the deal closes, so it does not hurt you to call someone and get an opinion rather than just going straight to whatever bank you did the loan with or whatever. I mean, you definitely want to make sure you're getting the best deal. And again, we get paid because we're competitive and we do a great job. And we don't charge you any sort of like fee to look at your scenario and give you some advice on where to go. So it definitely would not hurt you to do that. It would be a smart thing to do.
And I think, to kind of wrap this up, people are at one bank and they go, well, I'm going to go back there. What they don't realize is that there's 3 other banks over here that are having like they want volume. So what do? They go, cool, I'm just going to go 40 basis points lower than everybody else. So you literally, some people go, oh, I just refinanced 3 loans in my bank. You're like, do you realize you could have just saved 40 basis points if you just would have, and you don't need to call 40 banks. That's why there's a broker. Like you said, they work
what we do.
for free.
Or what about the guy that thought he needed the Freddie Mac loan for some odd reason? I mean, we ended up getting him a rate that was, 50 basis points
without
lower,
a yield maintenance prepay.
Without a yield maintenance prepay, because this is the thing. Back in the recession, there wasn't a lot of financing available. So we were refinancing owners, and owners were so scared that they were all saying, like a lot of them, I want the longest term fix I can possibly get. Well, who was doing that? It was Fannie. And so we did a lot of Fannie debt on 10-year fix. And I'm like, hey guys, you're probably going to regret this because this yield maintenance, like, don't call me in 5 years and say, Krystle, will they negotiate? Will they help me out with this? Fannie Mae is not going to negotiate a payoff with you. You signed on the dotted line that you got yield maintenance. Why would they give you a discount? Oh, if I bring my refi back. No, they were going to make a certain amount of money. So every owner we did these loans for, I said, you're going to regret this. Here's the option. This is what it is. I'm educating you on how it works.
They all did.
The people that took it have called me over the last 10 years and said, hey, the refi or cash out, or can you help me calculate my prepay? I'm like,
some of them you did 2-3 times.
People regret it and they forget that they were in this panic, 5, 6, 8 years ago. And now they want to do something. Again, this is an investment. This is a vehicle for you to leverage, to go buy other real estate, to sell, to trade up, to do all kinds of different things on. So when you're locked in with that yield maintenance, you have the least amount of flexibility possible. And even if you think you're never going to sell this property, you're never going to do that. I mean, how many properties were we never going to sell? It's like, no, you never know what's going to come up. It's an investment. It's a business. So you never know if you're going to take a really great offer that somebody gave you, or that you found another building that you really want to buy and you need to access some of your equity.
Yeah, I could tell there's at least a handful of deals where clients have missed out on great buys because they couldn't access their equity. They're sitting there with $3-4 million tied up in this building that they can't touch.
For 10,
they got yield maintenance.
Let's talk about
they're 3 or 4 years into a 10-year fix, so they're sitting on their hands for 7 years, and they're missing out on the appreciation we saw since 2012.
Yeah, one in particular, I was thinking, a gentleman. I remember when his loan got done again. We talked, and he's like, I can't tell you how many times I thought about how much money I lost taking this deal. And Krystle was like, I don't think you want to take this. You kept telling him you don't want to take this deal. Are you sure you're locked in? No, I want to have it. And that's the thing is he could have pulled cash probably twice over 10 years.
And not to mention the deals he could have bought.
Oh, I mean, I can't tell you how much equity do you think he had in his property? No. He had.
No, I think there's probably close to $4 to $5 million that was sitting there that he could have accessed. I mean, he had $7-8 million in equity, and he probably could have pulled out $4 or $5 million.
Yeah. So basically, our point is if you pulled out $4 or $5 million once, and then you just went and bought a couple properties with that, you could have doubled your money. So basically, he lost another $4. He could have been sitting on a lot of money. So he realizes, and this is why we say is when you're locked in, you're locked in.
And the one thing you really want as a real estate owner is flexibility. You want to be able to to pivot and move and do things whenever you need to. And prepayment penalties can really, really hinder you, especially yield maintenance. I mean, we even think about a lot of times for our clients, if I've got 3 different options for a 5 or a 7 or a 10-year fixed with a client, I'll usually give them to them. And one's like, hey, this is a really low rate, but you have this terrible prepay on it. Or, hey, this rate's a little bit higher, but you only have a prepay. Like maybe on a 5-year fix, I can get you a 3-year prepay. So the last 2 years are open for you to do whatever you need to do. Or this lender has a better rate, but they're qualifying at a higher DCR. So you're not getting as many loan dollars. Like, we're going to give you all the options so you can make the best decision. And it's funny because people are so rate sensitive, but that's not the whole picture. So, I mean, it's not about what your interest rate is per se. It's about what's your payment. What kind of flexibility can you get? What kind of closing costs? Like, there's other factors involved in your loan than just your rate.
Yeah, the other thing too is I think, we're not talking about these big, massive deals because they lock those up because they're going to be assumed it's a completely different model. When you're buying a 500-unit building for $100 million, that's a completely different model. So you guys like Grant Cardone and stuff, they do refi, but that's a different model. And also too, if you're starting as an active real estate investor and you're like, I'm buying this deal and I'm never going to sell it, like Krystle said,
you're going to sell it.
Mitch will tell you, how many times do we say, Mitch, we're not going to sell this one, and we said, nope, we're just going to hold it, even though we sold them all. Why? Because
there's other deals.
There's more money
else.
At the end of the day, it's not about the rate. It's not about all this stuff. It's about, like Krystle said, being fluid and flexible, and there's more money to be made. Once you get into the game and once you understand the game, if you're not an active real estate investor, if you own one building and you don't understand strategy because you're really not understanding how to build wealth. Building wealth is making sure you're flexible and maneuver. Look, if you got a ton of cash and you have a business that just throws off a ton of cash and you want to lock something up, that's a different story. But we're talking about the guy that is buying real estate, trading up, cashing out, and moving the needle every single year. And eventually they're trying to get to 500 units, 1,000 units,
maybe
whatever
you're not going to, maybe it's not to sell your property. Like I said, maybe it's to refi and pull cash out. Maybe you don't even think you're going to want to pull cash out, but maybe somebody in your family passes away, or your kid needs to go to college, or you want to do improvements to the property, or
somebody offers you a stupid price for your property.
Honestly, there's any number of reasons. You're going back to selling the property. You love to talk about that.
That's a reason, though.
Honestly, there's any number of reasons that you would want to be flexible with your portfolio. So there's just a lot of reasons. You want to be able to, the point is you need to be able to do what you want to do when you want to do it. So a prepayment penalty is definitely a big thing to consider in your loan.
And this is my last thought. I was talking to a real estate agent yesterday. He's a selling agent, and he told me that he locked in on a 3.25 on a 30-year fix about 5 years ago. And you know what he said to me? I will never refinance this ever. And he just refinanced it at 3.875. And I said, I'm so surprised. And he says, yep, because I had to consolidate debt. Mm-hmm. And I said exactly the same point. Everybody thought they locked in on the 3%, and Mitch and I were talking about, we're never going to refi. We're like, yeah, you will. No, you won't. We're like, yes, you will. No, we won't. Yes, you will, because you might go consolidate debt and credit card. You're paying 10%. Now you can go refi and get 3.875. It's like 3%. You can't borrow money that cheap. Not at the level you're at. Not at a normal human being. If you're a high net worth person,
if you can borrow against your house or anything else at 3-4%, and you go get 6% return on your money on another investment, like, why not?
That's exactly what we're saying. So, guys, the point is, if you're new real estate investors, old, experienced, whatever, most of them knows, having the flexibility is if you have that equity and you can grab it right now and get it at 4%, and you have an opportunity, which we do sometimes, is an off-market deal comes or you're in the game and you get that, you're like, oh my gosh, I can buy this property, and not only can I make cash on cash return of 6 to 8%, but I can make $500,000 in this by rehabbing it. What is what you're not even caring about this.
Yeah,
you're over here.
The base you borrowed at is
it's
the
4%.
The return is so much better than that.
And your money's sitting in the bank's making nothing. It's dead. It's useless. So I hopefully you guys got some nuggets. I wanted to bring Krystle and Mitch on to talk more about commercial real estate. talk about the financing. Obviously, if you guys have a scenario, like they said, just reach out. We don't make a nickel until we close a deal. So yes, we're incentivized to close deals. That's how we make money. That's how we make a living. That's how we buy Harlow shoes and clothes now. But basically, at the end of the day, we like to help people and educate people, and we're in a position where that's why we're here doing this, because we don't want to see somebody make a wrong decision that's locked in. We've already seen it, and they literally you're dealing with them calling you every other year, frustrated and pissed off that there's got to be a way to get out of this prepay, and we keep telling them it's $1 million. Now it went down to 600 or 500, or there's like right now, everybody's like, what should I lock into? Is it a 5-year? It's a 7-year. That's why you have to sit down and strategize. What's your game plan? What do you want to do? There's not more than just, I got to get the rate in this. It's like, it's a strategy talk. So if you're talking to, hold on, let me finish. If you're talking to a bank or a lender and they're not going over prepays and strategies and things like that, you're talking to the wrong person 100%. If they're just like, yeah, close a loan and do this, wrong. I'm just saying that's not a person you should be talking to.
I'm just saying.
Yeah, every deal's different. We try to structure for what your long-term goals are, not just what you need right now. Like what are your plans for the property? What are your 3 to 5 years? Are you looking to grow this portfolio? Are you looking to trade up? So we can help kind of guide you through those scenarios.
Krystle, last thought.
That is
close hard.
So what I was gonna say is the banks generally, I mean, we know a lot of bankers and we work with them and we have great relationships with them, but they're not really in the business of helping you to structure not just the one loan. I mean, they're there to essentially quote you rates and programs and be experts on their program, but they're not going to know the nuances that a real estate investor is going to think about. I mean, just as an example, we're helping a client with a purchase right now that was a referral. There are 2 vacant units right now and the seller is just super absent. We're helping them lease the last 2 units so they can get the loan that they need.
How's that for service, baby?
What banker is going to do that for you?
Hello, Bueller. Anyone? Are you listening? Mitch been going to all the appraisals. Who does that if they're here?
One of us attends all the appraisals, mostly Mitch these days, but one of us attends the appraisals. Why? Because we do. When we have clients that have us in the involved in the beginning, we like to go and see if there's going to be any issues that could come out. So, Mitch goes to the appraisals and your banker's not going to be doing these things. We do what it takes to get the loan closed. It's not a normal part of our business. I'm not a leasing agent, but you've
managed a few units though.
We've managed a few, but I mean, and that's where our experience kind of comes in. And then also just doing what it takes to get the thing done. So, that's my hard close.
That was a good hard close. Mitch, anything?
Yeah, check us out, PacificShoreCapital.com, YouTube, Pacific Shore Capital. Got a lot of videos up there with
Monty. Where are they at on Instagram, social media?
Pacific Shore Capital.
Pacific Shore Capital, Instagram.
Who would have thought?
Facebook.
Pacific Shore Capital.
Yep, and
LinkedIn,
that's
Moore.
it.
Yeah.
Thanks for listening.
Awesome.
Drive safe.